which there are, because of the leverage, you'll magnify your losses. If you put in $5 and let's say, you put in $5 of your own and somebody lends you 95, you buy 100 shares at $1 each. If those shares go up to $110, sorry, $1.10, you've made $10. That's great, you've doubled your money. If on the other hand those shares go down to 90 cents, that's not so great because you've actually lost more than what you put in. You put in $5, you've just lost 10. Not a great deal. And we'll have a look at a couple of trades where one we took that's made us a lot of money, and one that our system actually kept us out of, and it would have lost us a lot of money, so I'm glad it kept us out of that. Another risk is, well, it's not so much a risk, but it's something to be aware of, is that if you're borrowing 95%, you're paying interest on that, and the interest, normally it's the RBA cash rate plus 3%, so at the moment it's about 7.5%. When I started trading CFDs, I didn't take that into account, so I thought I was doing really well, and at the end of the first quarter when I reviewed my accounts, I thought, you know what, I haven't made any money. And I went back and I looked at it and I paid an enormous amount of interest. It actually worked out that I had to make about 20% just to break even. That's how much interest I was paying. It was a ridiculous amount of money. So that's, as I say, it's not a risk, but be aware of it. If you're going to trade these, you're going to pay interest and you have to make that. And there's also counterparty risk. Now, counterparty risk is the risk that the other side, the provider, is going to do the wrong thing by you. And not so much with the direct market access or the ASX, there's not much risk there. But the market makers, as I said, they control the game. They'll quote you the price, they'll decide if they take your order or not. They might take your order at a much worse price than what you were expecting. So that's the risk. Yeah, so, all right, let's have a look at a trade. Now, sorry, one thing I didn't say, because I'm happily trying to look through all of this, is if you've got any questions, please just interrupt. Don't sort of wait to the end and go, I'm really not understanding anything you're saying. Just butt in and say, can you explain that? Or whatever. Either I'll say, I'll give you the answer, or I'll say, yeah, can we come back to that later? So feel free to interrupt. Now this is BHP. This is the trade that I said our system kept us out of. BHP is actually a company that I don't trade CFDs on because it gaps around all over the place. You can see, I'm pressing the wrong button. You've got all these really big gaps here and there, and it's up and down, and you don't really know what it's doing from one day to the next. So we don't trade CFDs on this. But over here, we've had this really nice run up, and we've got one of these gaps here. Generally, gaps act as a bit of a support. So if you get a gap and then the market comes back down, it'll usually stop somewhere in that gap for a little while at least. So we've got that gap. Market comes down. Now, it's come down somewhere between 50 and 61.8%. Now, at this stage, I don't expect those numbers to mean much to you, but if you do our course, you'll learn that those numbers are quite significant. They really do offer a lot of support in the market, and so they're a number that we look for. And when the market stops between them like that, it's a pretty good sign. So we've got a couple of good things there in this setup. And then we get this really nice, strong up day there. And so that'd be a good buy entry. except, as I say, our system kept us out of this, which was a good thing. But, you know, you buy in at that price up there, and because it's so highly leveraged, one of the things you've got to do is work out, well, how much am I going to buy? And most people have some sort of system that tells them, yes, I'll buy this much, or you know, however they work that out. If you had $10,000 in an account and someone was going to lend you 95%, that means you've got $200,000 that you can spend, you know, invest in the market. So if you decided, well, gee, BHP is only at $40, that means I can buy 200,000, 5,000 shares, you beauty, you know. So you go and throw the whole lot under this trade, which we wouldn't do because we're all smart enough to work out that's a dumb thing to do. But I actually know someone that did something very similar to that, not quite those numbers, but put basically their whole account on one trade. So let's assume for the moment that that's what we've done. We've put our whole $10,000 on this trade. The next day, the market's down a bit. It's still all right. It's still at $40, which is roughly where we entered. Following day, it's gone up a bit. We're feeling a bit happier with ourselves. And then, oh crap, it's down, way down. Now, it's actually down about $1.50 there. So, to put it in context, if you've got $10,000 in your account, you've just bought 5,000 of these things and they've dropped $1.50, that's 75% of your money gone. Funny thing with people's psychology is that they look at that and they go, oh God, you know what? I can't afford to lose that much, so I'll hang on to this for another day and hopefully it'll go back up and I'll be okay. You know, that's the mentality. So the next day, oh, sorry, I didn't put it there. The next day the market actually opened down further and it would have wiped out the whole $10,000. So, you know, a couple of lessons from that. One is know how to determine how much you're going to invest, and we have a formula for that, which I'll run through with you a bit later. The other thing is, if it does get down, just take the loss. Doesn't matter how big it is, you know, it'll always be worse the next day. You'll never survive this game if you're hoping, gambling, that it's going to go up the next day. One of the traders who I really admire is an American guy called Paul Tudor Jones. He was a trader really big in the late 80s and early 90s. And he said that trading is about playing great defense. It's a game where money's just the scorecard. So, you know, if you're playing the game well, you'll make money. If you're not playing it well, you'll lose money. If you're losing money, play defense. That's his philosophy, and I totally agree with it. So, here, you know, we're doing that. Markets gap down, take the loss, move on, take the next trade. So, the next trade is Newcrest Mining. Newcrest is a gold mining company, and I really like this, as you can see. It gaps around a little bit, but nowhere near as much as BHP. So we actually trade this, and again, we've got this really nice leg up with a little gap there in the middle. Market has come down, it's stopped just above that gap. Again, it's between the 50 and the 61.8%. So, pretty good setup again. Now, again, our system kept us out of this trade at this point. But up here on this circle, candle that I've circled, our system got us in. And I think from memory, it got us in pretty much at the closing price, around 34.70. So, we took the trade, market went up, it went up again, and then jumping forward a bit because it just went sideways, you know. But it was still doing okay. It was still well above it.